Well, if you are an income investor, maybe REITs might be the best asset class designed for you. Real estate investment trust or REIT is a great instrument for both investor and also the sponsors. This allows property companies to cash out and recover part of their investment so they can redeploy these funds for new project. But it also allows investors like ourselves to gain access to a much wider range of property that would otherwise maybe be out of reach for an average investor. In theory, REITs are extremely simple investment instrument. They basically securitize a portfolio of properties into a trust fund, and investors just buy units of that trust. Everyone would then get a share of the rental income coming from this property, as REITs are obligated to distribute out about 90% of its income. However, the instrument can be abused and investor could very easily be taken advantage of from either the managers or the sponsor if we are not careful. We might not even be able to protect ourselves against all risks when investing in REITs, but here are some of the things that we should look out for when investing in REITs so that we can minimize falling into a bad REIT. Number one, the status of the property. The REITs is backed by the asset that it holds, and we're basically buying a partial ownership of properties. So the easiest way to check on the status of these properties, even if they're overseas, is just to run through them on Google Maps. Google Maps is your friend when it comes to checking out the properties within a REIT. The REITs will provide detail about where the properties are or what they're named. So simply by entering that into Google Maps, we'll be able to look around the surrounding, the property itself, and even its condition. It can be extremely useful instead of just relying on the REIT's marketing shots. Another issue that you need to consider is the land lease of the properties. Most property within the REITs are leasehold properties. For example, industrial REITs in Singapore sits on a 30-year lease most of the time. So imagine if you buy one industrial property for investment, then we rent it out at say 7% yield. By the end of 30 years, we get back roughly about 210% of our capital. But at the end of that lease, our property could be worth zero. Thus, this means that your rate of return is just a mere 2.5% a year. Of course, we can then boost that return through a mortgage, but if you're buying through a REIT, that return is basically based on their leveraged return. So we need to gauge if the return can justify the possibility of depreciation within the property. And sometimes the REITs go around this problem by acquiring newer property all the time. However, that might mean that they would either need to issue more rights from us to fund this acquisition or give us dilution risk if they're issuing more units to buy these properties. Next is looking at the acquisition history. In an ideal situation, we want to REIT with a long list of possible acquisition from its sponsor, and that the sponsor will sell this property over to the REIT at an attractive valuation so that these acquisition can be accretive to unit holders. Accretive means that the distribution per unit for investors would increase after the acquisition. And in this way, investor would end up getting a higher yield after every purchase. Yet in practice, that is not always the case. So always check the past history of acquisition to see if the REIT manager has been fair to investors. If not, your return might end up declining over time. Next, you must also check on the tenant mix. When I'm talking about tenant mix, I'm not too worried about the REIT being too exposed to one particular industry. After all, one REIT can be serving just one industry and that will be fine. This is because as an investor, we can diversify that risk away by investing into other types of REITs. What I'm interested in is understanding the distribution of the rental income coming from its tenant mix. So if a REIT is getting a huge portion of its rental from just one tenant, then it might show that it doesn't have a good pricing power over the tenants. Say for example, Star Hill Global REIT obtained more than 24% of its rental from just one tenant. And that could be a dangerous situation. In fact, it could be held hostage by that tenant, as losing them could be disastrous for the REIT. Now compare that to, say, Capital Land Integrated Commercial Trust, which only get 5% of its rental from its largest tenants. This means that CICT is not dependent on any one tenant and might have better pricing power over them. Another important point to look into is the leverage. A REIT would need to fund its acquisition with loans, similar to how we fund our property with mortgages. The loan could be coming from a bank or from the bond market. It is important to check on the interest rate that the REIT is getting from this loan. Some REITs might be able to gain access to cheaper financing due to the strong status of, say, their asset or their sponsor. And that is why larger REITs tends to be able to finance their property with more favorable terms. And apart from that, we have to ensure that the REITs does not have too high a leverage, as having leverage is always a double-edged sword. And leverage can lead to a big risk that all REITs have. In a REIT structure, the trust tends to own long-term asset like property, which could last maybe 30 to 100 years. However, these assets are most likely financed by relatively short-term loans, say from 3 to 7 years. Thus, the REITs will need to constantly refinance this loan on an ongoing basis. However, when financing dries up, say in a financial crisis, the REIT will be stuck and have a liquidity issue. This is exactly what happened to Capital Landmark Trust during the 2008 crisis. And the only way out of it is to raise a huge rights issue from investor, greatly diluting them or forcing them to add more capital to bail out the REIT. So even if the REIT is giving investors a high yield at the moment, that distribution could have to be returned to the REITs in a time of crisis. So something again that we need to be aware of when investing in REITs. Next, we have to look into how the managers are paying themselves as well. A REIT is managed by two parties, the REIT manager and the property manager. And for you, it is important to note how these parties are compensated. This is because with a wrong compensation system, it could lead to many conflict of interest. The REIT's manager is in charge of managing the REIT, the finance and operating functions like compliance and deciding on asset enhancement and finding new investment. The property manager, on the other hand, only deal with issues surrounding the property, such as, say, maintenance and renewing of lease. This is a typical example, say, of a fee structure within a REIT. Say, for example, the REIT's manager might get a base fee, say 0.5% of the total value of asset held within the trust. Then also an additional performance fee, say up to 3% of their net property income. Sometimes the manager will also get a commission fee for any acquisition or divestment as well. But this should be low or even non-existent. If not, the manager will be very incentivized to constantly look for deals instead of managing the REIT properly. As a rule of thumb, as investors are more interested in the income generated from the portfolio, a REIT manager should get most of his compensation from that income performance. Next, the property manager are also compensated in quite similar manner. For example, they get maybe around 3% per annum on the property income and maybe half to 1 month of gross rent when securing a new tenancy. The property manager tend to have a more standardized income as they are more involved with the maintenance of the property. And after looking at that, we might want to look at the distribution yield. The REIT is, after all, a yield instrument. So when we're buying one, we should not be focused too much on the growth potential, but rather looking at how sustainable the distribution is. And when I say distribution, I'm talking about distribution per unit. This is because the unit count of a REIT is constantly changing due to, say, unit payments to the managers or private placement or rights issue. So the income from the REIT might be increasing, but the distribution per unit for the REIT can stay stagnant or even decline. At the end of the day, it is the distribution per unit that is relevant for you. And you can check that distribution history by just going to their investor relationship website, and you'll be able to see whether it has a stable or growing distribution per unit over time. Anyway, let us know from the comments below which of the REIT that you're looking at fit all these criteria. And if you've gotten value from the video, please give us a like and share it with a friend who you might think will benefit from it as well. If you enjoy our content, you can always go down to our website at valueinvestasia.com and maybe click on Premium Club to find out what we can do for you even more. Anyway, as always, my name is Stanley. Till we meet again, invest safely.